Hello, my name is Nicholas Gehring, and this is my report and analysis on Hong Kong Shanghai Bank of China, also known as HSBC. The history of HSBC starts when Thomas Sutherland and other businessmen in 1865 opened the doors to Hong Kong and Shanghai Bank, financing and promoting British imperial trade in opium, silk, and tea in East Asia. It soon established a London office and created an international branch network emphasizing China and East Asia. War repeatedly disrupted but never demolished the bank's operations. During World War II, the headquarters were temporarily moved to London. They moved back on a permanent basis in 1991. The bank played a key role in Hong Kong's post-war growth by financing industrialists who fled there from China. In the late 1950s, Hong Kong and Shanghai Bank's acquisitions included the British Bank of the Middle East and Mercantile Bank. In 1965, the company bought 62% of Hang Seng, Hong Kong's number 2 bank. Other acquisitions included Marine Midland Bank in the U.S. in 1980, Hong Kong Bank of Canada in 1981, and Lloyds Bank Canada in 1990. Following the 1984 agreement to return Hong Kong to China, Hong Kong and Shanghai Bank began beefing up in the UK, buying London securities dealer James Capel and Company in 1986 and the UK's number 3 bank, Midland plc, in 1992. The company has never merged with another, but it has always been its policy to grow through acquisitions. The top members of the board of directors are Douglas Flint, the group chairman, Stuart Gulliver, the group chief executive, Ian McKay, the group finance director, and Mark Moses, the executive director and group chief risk officer. Douglas Flint started his career as a chartered accountant. He joined HSBC in September of 1995 and was appointed to the board as the group finance director that December. He became the chairman in 2010. Mr. Flint had an annual compensation totaling $2.136 million in 2016. Stuart Gulliver joined HSBC in 1980 and has held a number of key roles in the group's operations worldwide. He was chairman of Europe, Middle East, and Global Businesses of HSBC Holdings plc prior to his appointment as the group chief executive in January of 2011. His total annual compensation for 2016 was $5.675 million. Ian McKay was appointed to the group finance director of HSBC Holdings plc in December 2010. Mr. McKay was a chartered accountant who had joined HSBC in 2007. Initially, he served as the chief financial officer of HSBC North America Holdings, Inc. From 2009 until his appointment in his current role, he acted as the chief financial officer of the Asia Pacific HSBC Holdings. His total annual compensation for 2016 was $2.953 million. Finally, Mark Moses was appointed as the executive director of HSBC Holdings plc in January 2014. He is also the group chief risk officer, managing risk and compliance, and has been since December 2010. Mr. Moses originally joined HSBC in November 2005 as the chief financial risk officer, focusing on the global banking and markets finance and risk functions. In January 2008, he also was assigned to the chief of staff for infrastructure in global banking and markets. His annual compensation for 2016 totaled $2.936 million. HSBC Holdings plc provides a variety of international banking and financial services, including retail and corporate banking, trade, trusteeship, securities, custody, capital markets, treasury, private and investment banking, and insurance. HSBC Holdings operates worldwide. Many of the activities HSBC engages in can be labeled under the term banking, with roughly 65% of HSBC's revenue from such activities. Noteworthy competitors in the industry include Banco Santander S.A., Bank of America Corporation, and Barclays plc. Banco Santander attracts deposits and offers retail, commercial, and private banking and asset management services. The bank offers consumer credit, mortgage loans, lease financing, factoring, mutual funds, pension funds, insurance, commercial credit, investment banking services, structured finance, and advice on mergers and acquisitions. It offers retail banking and consumer finance in Portugal, the UK, and other parts of Europe, and is a top banking group in Latin America with almost 40% of the group's attributable profit from there. Bank of America Corporation accepts deposits and offers banking, investing, asset management, and other financial and risk management products and services. The company has a mortgage lending subsidiary and an investment banking and securities brokerage subsidiary. The bank's core services include consumer and small business banking, corporate banking, credit cards, mortgage lending, and asset management. Barclays plc is a global financial services provider engaged in retail banking, credit cards, wholesale banking, investment banking, wealth management, and investment management services. Barclays owns one of Europe's largest banks, a top market-making investment bank, the top UK credit card, and an international wealth management firm. Altogether, Barclays serves more than 48 million customers in more than 50 countries. HSBC trades at approximately $40 a share. Banco Santander trades at about $6, Bank of America trades at about $23, and Barclays trades at about $11. Relative prices are meaningless, however. A better metric to gauge between stocks is their relative percentage gain or loss from a starting period. This can be seen here in the 5-year chart. Bank of America had increased over 200% of its value from 5 years earlier, but is now closer to 180%. HSBC, Barclays, and Santander all traded within a narrow range relative to each other, with Santander having a strong growth in 2014, but reverting back to the others, while Barclays increased relative to HSBC and Santander during 2015, but also reverted back to a similar price appreciation as the others. HSBC, Barclays, and Santander all have lower stock prices than 5 years ago, with Barclays being the worst performing by a small margin. HSBC is quite a large bank with a market capitalization of over $152 billion. Only Bank of America listed here has a higher capitalization, which is largely due to its acquisition of Merrill Lynch during the financial crisis. As you can see here, HSBC has a PE ratio of 17.4, meaning the price of the stock is 17.4 times higher than the earnings per share. That is pretty average when compared to its competitors. Banco Santander is rather low with 13.79, while Barclays is on the higher end. Bank of America has a PE ratio of 15.19. It can be used as a good indicator for the relative value or costliness of a stock. Stocks with a high PE may be priced that way in expectation that the earnings of the company will pick up in the coming years. Their earnings will grow into the price valuations. HSBC has received a Moody's rating for long-term bonds of AA2. This is towards the upper end of the rating system, well within the prime status. It is a high-quality rating that denotes very low credit risk. Although it received a negative outlook on future ratings, it has been able to maintain a high rating backed by its strong financials. This score is significantly higher than its peers. Banco Santander received a rating of A3, the lowest possible rating before it is no longer considered prime. It is deemed medium grade and subject to medium risk. This is not as bad, however, as Bank of America, which received a score of Baa1. The rating just below A3 and is outside the prime status. This rating denotes moderate risk. Barclays has a pretty good rating of A1 in the middle of the prime range, and it denotes fairly low credit risk. Beta is a measure of a risk of a company. In general, a beta is a multiplier of a company's relative returns to the market. A beta higher than 1 means the company in general moves with more volatility than the market, and a beta of lower than 1 means the company moves less than the market. The market itself has a beta of 1 by definition. HSBC has a low beta of 0.79, meaning one would not expect much price volatility for this stock. This is significantly lower than its competitors, as Banco Santander has a beta of 1.38, and even less than Bank of America with a beta of 1.6, which is very high. Bank of America's beta represents price volatility movements that are very high. Barclays has an average beta of 1.04. In general, the stock is not much more volatile than the market. HSBC has a dividend yield of 2.55, or 6.28% currently. This is rather high when compared to its competitors and is one of the most positive attributes of HSBC. Banco Santander has a dividend yield of 4%, Bank of America has a dividend yield of 1.3%, and Barclays has a dividend yield of 3.5%. For HSBC, the yield has been going up, as HSBC has been increasing the dividend paid while the stock price has remained rather unchanged over the past 5 years. It is important to note that it is important to not just discuss relative yields, but to include the growth rates as well. The 10-year dividend growth rate is 14.2%, and its 5-year growth rate is 15.6%. This accounts for the very high yield, which was only 4.5% 5 years ago. Not only does HSBC pay a larger dividend in terms of yield than its competitors, it also has a strong dividend growth rate. HSBC has had earnings per share growth rates of negative 2.18% and negative 4.22% for the past 5 years and 10 years respectively. This is in large part due to the 2008 and 2009 financial crisis, which has left many banks and financial institutions permanently marred. As you can see, none of its competitors were unaffected by the crisis. However, HSBC has positioned itself in recent years to generate returns going forward with an expected future earnings per share growth rate of 6%. This is partly due to its reducing of its unsuccessful parts of the business and reinvesting in the more successful areas. Its cost-cutting activities should help it maintain positive earnings going forward. Although a reduction in earnings over the past 5 and 10 years sounds bad, it is not as bad as its competitors. All competitors, including Banco Santander, Bank of America, and Barclays, all saw negative growth rates in their earnings per share. Barclays was hit especially hard during the financial crisis and has been impacted in recent times by the Brexit concerns. In terms of capital structure, HSBC has total assets of $168 billion and is considered a large cap company. As of September 30, 2016, it had a long-term debt total of $71.7 billion, $70 billion of which is due in the next 5 years. There is $12.4 billion of preferred stock, which leaves approximately $83.9 billion as equity available to common shareholders. Therefore, HSBC is financed with about 42.7% debt, 7.4% preferred stock, and 50% equity. Generally, banks are financed more with debt than equity. However, HSBC maintains a larger percent of its capital structure as equity. This means that HSBC is less leveraged than its counterparts, and so if the economy does poorly, it will not suffer as much as other institutions financed more intensely with debt. The other side of the coin is that HSBC will not benefit as greatly as other companies who are leveraged more with debt. Debt acts as an amplifier of returns. This makes sense as HSBC's beta was 0.79, rather low, and is less affected by changes in the economy and will be less volatile. However, with debt being the cheapest it has ever been, it might be wise for HSBC to increase its debt financing, as it may not have such a strong opportunity to receive cheap funding in the future. The cost for its long-term debt must also be relatively cheap, as is a AA2 rating from Moody's. HSBC has had a return of equity of 5% in 2016. It had 7.2% return on equity in 2015 and 2014. This last year's ROE was the lowest it had been since 2009 during the financial crisis. This is due to the poor earnings reported for 2016. HSBC recorded net income of just $1.84 billion compared to $8.85 billion and $8.31 billion in 2015 and 14 respectively. HSBC brought in an earnings per share of just 2.25 in 2016 as compared to 3.2 and 3.45 in 2015 and 14 respectively. The company has promised its annual report that the drop in profits were caused by one-time expenses tied to trimming away poorly performing branches and spending in favor of the future well-being of the company. HSBC's foreign exchange risk arises mainly from loans to subsidiaries that are not denominated in the functional currency of either the provider or the recipient and which are accounted for as financial assets. Changes in the carrying amount of these loans due to foreign exchange rate differences are taken directly to HSBC Holdings' income statement. These loans and most of the associated foreign exchange exposures are eliminated on consolidation. In this way, HSBC operates much like a transnational company. Each entity operates within its own country when dealing with its own currency, and there is no exchanges of capital of different currencies between HSBC and another company. Any exchange made between entities will not impact the consolidated company because any loss from one entity would be the gain for the other entity. For the investor, foreign exchange risks exist by the effects of exchange rates changing between the currency the ADR is purchased in, US dollars, and the currency in which the parent company trades, British pounds. In general, investors in the US want the dollar to depreciate against the foreign currency of the ADR, as this would cause the price of the ADR to rise. This is because as the pound becomes worth more dollars, the relative value of the company is increased in terms of US dollars, causing the price of the ADR to appreciate. The forward rates of the pound and the US dollar are relatively flat. HSBC, being a global organization, must consider geopolitical risks. The company cites the fact that operations and portfolios are exposed to risks arising from political instability, civil unrest, and military conflict around the world. They make note of the outcome of the election here in the United States and the state of affairs in Europe. Many banks rely upon, or at least have become more comfortable with the concept of globalization. Breaking down barriers and allowing the free flow of capital is something HSBC requires in order to operate efficiently and without undue cost. If the wave of populism and protectionist policies get passed, there may be a curtailment in global trade which would directly affect HSBC's business. Heightened tensions in Europe due to terrorism, concerns with Russia's actions, and political alteration have caused a rise in the level of uncertainty in policy and markets. In addition, in Asia, a prominent region for HSBC activities, diplomatic relations have been strained by ongoing territorial disputes in the South China Sea. HSBC continually monitors these risks and creates its own outlook and prospects for the future. HSBC has established a dedicated forum to keep management informed and up to date on global developments to provide insight into strategy to account for uncertainty. Physical security has been increased in areas prone to terrorist acts, and incident responsiveness has been improved. Internal credit risk ratings for sovereign counterparts in areas with high levels of geopolitical risk have been established to properly value the business outlook in such areas. Exposures to such areas may be adjusted as the need arises. HSBC has performed quite poorly as a stock since the financial crisis. Its recovery is slow and lags behind that of comparable bank stocks. HSBC's return on equity has not been this low since the financial crisis. However, prior to this past year, return on equity was fairly consistent between 7 and 10%. HSBC has claimed that the losses incurred this year are temporary and one-time occurrences that will open the way for cheaper and more efficient operations going forward. The company is still well below its 5-year range, though it is near its 52-week high. If the company can continue to post earnings similar to 2015 and the several years prior, then the price will surely go up as the stock price is still rather deflated and potentially undervalued if they can deliver on what they are promising. HSBC has positioned itself well to prevent any large losses or damage that could be caused by another crisis. They have large cash reserves at the moment which can help cushion any blow. This may be needed as the next few years may pose significant risks to all banks. Though a Trump trade is supposed to be reflationary, which would cause a rise in interest rates and thus bank margins, HSBC specifically does not have too large a U.S. market share and may instead feel the negative effects of protectionist policies. This, compounded by the uncertainty over the South China Sea, could cause unnecessary strain on the returns of HSBC. The one bright aspect is its solid dividend, which may provide consistent income while it hammers out these issues. Overall, I recommend holding HSBC stock if currently owned, but do not recommend to buy at this time. Thank you.